The state and local tax, or SALT deduction. It's a term you'll often hear in discussions about tax planning and policy. Has long been a major feature of the U.S. tax code, playing a significant role in how Americans calculate their federal tax obligations. Its history is intertwined with the very fabric of our tax system, allowing taxpayers to subtract certain state and local taxes from their federal taxable income, effectively reducing their overall tax liability. This subtraction can lead to substantial savings depending on individual circumstances. For many, especially in high-tax states, where state and local taxes can be particularly burdensome. This deduction has meant real savings, providing much-needed financial relief and allowing families to allocate resources to other essential needs, and shape decisions about where to live and buy homes, influencing choices based on the overall tax burden in different localities. The deduction covers state and local income taxes, encompassing a wide range of income-based levies imposed by state and municipal governments. Sales taxes, which are taxes on goods and services purchased at the point of sale, plus property taxes levied on real estate and other forms of property, often representing a significant expense for homeowners. Aiming to prevent double taxation by the federal government, a principle designed to ensure fairness and avoid penalizing taxpayers for contributing to both state and federal coffers. Imagine earning $100,000 and paying $7,000 in state income tax and $5,000 in property tax. SALT once let you deduct the full $12,000 from your federal taxable income, providing a substantial reduction in your overall tax burden. This relief was especially vital for residents of states like California, New York, and New Jersey, where high property values and tax rates are common, making the SALT deduction a critical component of financial planning. The deduction also helped state and local governments fund public services, as it reduced the pressure on residents and enabled them to support local initiatives. By softening the federal tax blow for their residents, creating a more sustainable financial environment for communities. Understanding SALT is key to grasping the recent changes and how they might impact your personal finances and tax strategy. And ongoing debates about tax fairness and federalism, as different perspectives clash over the appropriate balance between federal and state taxing powers. As we explore the new SALT cap, remember, it's a significant shift in the tax landscape with far-reaching consequences. This deduction has always been about easing the burden of paying taxes on taxes. It's a concept that resonates with many, and its implications are worth understanding. The Tax Cuts and Jobs Act of 2017 brought about sweeping changes to the American tax landscape, altering long-standing rules and impacting taxpayers across the nation. One of the most significant shifts was the introduction of a cap on the state and local tax, SALT, deduction, setting a limit of $10,000 per household. This single provision reshaped how many families approach their tax planning. Before the act, most taxpayers enjoyed the ability to deduct the full amount of their state and local taxes from their federal income tax liability. This offered substantial relief, particularly in states with higher tax rates. However, with the new law in place, even families facing significantly higher state and local tax burdens found themselves restricted to a maximum deduction of just $10,000. This created a stark contrast to the previous system. To illustrate, consider a family residing in a state with high property taxes and income taxes, resulting in a combined state and local tax bill of $12,000. Under the new regulations, this family could now only deduct $10,000 of those taxes on their federal return. This meant they were effectively losing out on a $2,000 deduction, increasing their overall tax liability. The impact was even more pronounced in high-tax areas, where some families routinely paid $35,000 or more in state and local taxes each year. Despite this substantial tax burden, they were still limited to deducting only $10,000. This left a significant $25,000 of their state and local taxes non-deductible, leading to a considerable increase in their federal tax bill. Proponents of the cap argued that the unlimited SALT deduction disproportionately benefited high-income earners, particularly those residing in affluent, high-tax states. They also suggested that the cap would encourage fiscal responsibility at the state level, curbing excessive state tax increases. Furthermore, the revenue generated by limiting the SALT deduction helped to offset the costs of other tax cuts included in the 2017 Tax Cuts and Jobs Act. However, for many families, particularly those living in states with high costs of living and correspondingly high taxes, The SALT deduction cap felt less like a tax reform measure and more like a financial penalty imposed simply because of their geographic location. The blanket $10,000 limit failed to adequately account for the significant regional disparities in state and local tax burdens across the country. This made it a rather blunt instrument, disproportionately impacting families in certain areas while having a negligible effect on others. Almost overnight, the previously substantial SALT deduction was transformed into a limited benefit, significantly reducing its value for many taxpayers. In many cases, particularly for middle and upper middle class families residing in suburban areas, the $10,000 limit was quickly exhausted by property taxes alone, leaving no room to deduct state income taxes or other local levies. In July 2025, Congress passed the Taxpayer Fairness and Relief Act, raising the SALT deduction cap to $40,000. Thresholds are expected to begin around $400,000 single filers and $500,000 for married couples filing jointly. This change eliminates the so-called marriage penalty and restores much of the deduction's value for families in high-tax states. Now, a couple paying $35,000 in state and local taxes can deduct the full amount, saving thousands on their federal tax bill. The new cap applies starting with the 2025 tax year, so taxpayers should plan accordingly. The increase isn't retroactive, but it marks a major shift away from the strict $10,000 limit. Taxpayers can still choose to deduct either state income or sales taxes, plus property taxes, maintaining flexibility for those in states without income tax. The main change is the much higher ceiling, reopening a key avenue for tax savings. For many, this is a long-awaited return to meaningful relief from double taxation. The biggest winners are middle and upper middle-class homeowners in high-tax states like New York, California, and New Jersey. For families whose state and local tax bills easily exceed $10,000, the new $60,000 cap is a game-changer, saving them thousands each year. State and local governments also benefit, as the higher cap makes it easier to fund public services without overburdening residents. Small business owners and professionals who pay high state taxes on business income can now deduct much more, lowering their effective tax rates. The real estate market in high-tax states may also get a boost, as the higher deduction makes homeownership more affordable and attractive. By restoring a significant portion of the deduction, the new law helps stabilize property values and supports local economies. For many, the higher cap means renewed financial flexibility and confidence. Most Americans won't see a direct benefit from the higher SALT cap. That's because the majority now take the standard deduction, which is often higher than their itemized deductions. Residents of low-tax states or those with modest property taxes were never limited by the old cap, so the increase doesn't affect them. Renters and lower-income households, even in high-tax states, typically don't pay enough in state and local taxes to itemize. The expanded cap mainly helps higher-income homeowners in a handful of states, not those most in need of tax relief. Even some high earners in expensive states may still pay more than $40,000 in state and local taxes, so the cap isn't unlimited. While the new law offers substantial relief, it doesn't restore the full deduction for everyone. Supporters of a higher SALT cap argue it's about fairness. Taxpayers shouldn't pay federal tax on money already sent to state and local governments. The deduction respects state autonomy, letting states fund services without punishing their residents at the federal level. The $10,000 cap was seen as an attack on high-tax states' policy choices and a blow to federalism. Economically, the cap hurt real estate markets and encouraged high earners to move to lower-tax states, draining local economies. Raising the cap is seen as a way to stabilize property values, reduce tax-motivated migration, and support middle-class families in high-cost areas. Proponents say the deduction isn't just for the wealthy, it's vital for dual-income professional households facing high property and income taxes. For many, the higher cap is essential relief for the backbone of the economy in America's most productive regions. Critics raise several concerns about the potential consequences of raising the SALT cap. A primary argument is that it disproportionately benefits the wealthy, offering them a significant tax break. This is because lower and middle-income households typically do not itemize their deductions, meaning they wouldn't see any direct benefit from the change. Therefore, they view it as a regressive policy, one that favors those already in a financially advantageous position. This regressive nature, they argue, diverts crucial federal resources away from those who need it most, exacerbating existing inequalities. These resources could be better allocated to funding essential programs designed to support and uplift lower-income families. Furthermore, the higher cap inevitably leads to less revenue for the federal government, impacting its ability to fund various public services. This revenue shortfall could potentially force budget cuts in other vital areas, or necessitate higher taxes for everyone to compensate. Another argument is that the deduction effectively subsidizes high-tax states, rewarding their spending habits. This makes it easier for these states to continue raising taxes and increasing spending, knowing that a portion of the burden is offset by the federal government. Consequently, the cost of these high-tax states is spread across all federal taxpayers, regardless of where they live. The implementation of the $10,000 cap was, in part, intended to encourage states to be more fiscally responsible and accountable to their own residents. The goal was to reduce their reliance on what some perceive as a federal subsidy, promoting greater financial independence. Furthermore, opponents emphasize that the majority of the benefit from raising the SALT cap is concentrated in a relatively small number of states, primarily those with high state and local taxes. This concentration of benefits contributes to and exacerbates existing regional inequities across the country. For taxpayers residing in states with lower tax burdens, the prospect of a higher SALT cap can feel like an unfair burden. It can be perceived as an unjust transfer of wealth from their communities to wealthier states and individuals. Ultimately, the debate surrounding the SALT cap is not solely about tax policy, it's deeply intertwined with geography and political ideologies. These factors significantly shape the perspectives and arguments on both sides of this complex issue. With the new SALT cap in effect, taxpayers who itemize should review their withholding or estimated tax payments for 2025. If you expect to deduct more than $10,000, you may want to adjust your W-4 or estimated payments to avoid overpaying the IRS. Keep meticulous records of property taxes, state income or sales taxes, and major purchases if you plan to deduct sales tax. Organize your documents early to make tax filing smoother and to substantiate your deduction if needed. Consult a tax professional to see if itemizing under the new rules is your best option, especially if you have mortgage interest or charitable deductions. Strategic planning, like bunching deductions, can help maximize your tax benefit. The new rules are complex, so professional advice can help you make the most of the expanded deduction. The higher SALT cap is set to expire at the end of 2030, so its future is uncertain. Congress could extend, reduce, or eliminate the cap, or even return to an unlimited deduction. Taxpayers should plan flexibly, knowing the rules could change again in a few years. States may continue to use workarounds like pass-through entity taxes to help residents bypass federal limits. The SALT deductions journey reflects ongoing debates about tax fairness, federalism, and the balance between state and federal power. Staying informed and adaptable is key for taxpayers, especially in high-tax states. For now, the $60,000 cap offers significant relief, but the political debate is far from over. The only certainty is that the SALT deduction will remain a hot topic in tax policy for years to come. Please like, share, subscribe.